start with a real quick review of the banking landscape. Last year, we commented about the numbers of banks that had started in 2003 that at the same time the Citizens Bank actually commenced operation, and there were 119. There are 47 of those still operating, less than 40%, and just in the last year we've had 6 additional banks either fail or change charters for some reason. Of the 47 that remain nationwide, Citizens Bank and Trust is the 15th largest, and of the 3 that were chartered in Alabama, we're actually the largest.
Since we talked to you last year, we've had a really good year, and we'll talk to you more over the next few minutes about why that's really important. But we've had almost $50 million in asset growth, which puts us at about just under $450 million in assets. And just for perspective, the largest independent bank that had operated in Marshall County prior to our opening in 2003 was Home Bank, and the highest asset mark they got to was 150 million. So we're almost 3 times that size now. But in the last 12 months, we've had almost 14% asset growth, almost 10% loan growth, a little over 14% in deposit growth, and maybe most importantly, our net income is up almost 18%. Echoing what Charlie said, there's been a huge change in the landscape of banks, and really banking has become a survival of the fittest. Going back to 1980, that huge drop between 1980 and 2008 had a lot to do with regulation. A lot of it, banking laws within states said that a lot of them were unit banking states. So just like in Alabama, there were 40 different charters of banks in Alabama for South Trust that all merged into one, and that accounted for a lot of the change from 17,000 down to 9,000. But between 2008 and 2016, a lot of those were because of failures. But you can see a tremendous amount of consolidation continuing. And what's really surprising is you would think that from 2016 to 2017, it would have stopped. From 2008 to 2016, there were close to 1,000 bank failures, but in the last year, there were only 8 bank failures. But you can see that there were still over 500 banks that went by the wayside. And that's just because in today's regulatory environment, it's tough to make it. The banks that continue to survive are going to be those that are well managed, great plan for survival, and are in markets that can sustain growth, which fortunately we're blessed to be in this marketplace. And you can see from the numbers on the prior slide that we have been able to continue to make money and thrive and be able to grow. And over the next few slides, we're going to show why that's really important to the markets that we serve.
But before we leave this slide, I think when we saw the 500 or so that had declined in just between 16 and 17, it was a shockingly large number to us. I think most people in the banking world feel as though there's a size that banks need to reach to be efficient. It's just a hard number to define. A lot of people are worried about that efficiency figure, particularly with the regulatory environment we're in. Some banks just don't have succession plans in place. Some just get weary of dealing with the regulation, but the large numbers of declines we don't necessarily see slowing. Mike was speaking to a group recently and was asked a question about why there are so many banks in Marshall County, and I found his answer interesting, so I'm going to ask him the same question now.
My answer was that it's really not the number of banks, but it's the number of good banks that are really serving the needs of the community. Go to the next. We operate in several different counties, but I'm just going to use Marshall County to really illustrate my point. When we began business in 2003, of course, we really didn't have any deposits, and the only market share numbers we really have to go by are those provided by the FDIC, and we only get one-day numbers as of June the 30th, and they don't come out until the end of September. So the most recent numbers we have are June 30th, 2016. But in Marshall County, The total deposits as of June of 2003 were $1,231,000,000. They grew up to $1,500,000,000 in June of 2009, dropped back down during the recession, and fortunately our economy has grown back and we're up to $1,544,000,000 now, which even though we're not nowhere close to that in population size, it makes Marshall County the 14th largest banking market in the state. So it's a really good market. You would think some other markets that are larger population-wise would be larger, such as Marshall County is considerably larger deposit-wise than Etowah County is. So it's a good banking market to be in. But what's really interesting is what's happened with the market share in Marshall County. When we began, the largest banks, which at that time were South Trust, Regions, AmSouth, Colonial, Compass, had 70% of the market share in Marshall County. Today, those banks, of course, they've changed a little bit with South Trust now being Wells Fargo and Colonial now being BB&T, are now down to 50%. We have grown from nothing up to just under 20% market share, and the other 10 community banks have grown from a little under 30% to a little over 30%. So the community banks in 2003 had about 28% of the market. Now they hold 50% of the market. And we've captured, of course, a big part of that. Point being, the holding company banks have somewhat abandoned the needs of more rural markets, and the community banks are serving the needs of the more rural markets like Marshall County. And we are really serving the needs much better and are capturing a large part of the market share in counties like this. And you can see, we use Marshall County as an illustration, but if you looked at Coleman County, Jackson County, other counties around northeast Alabama, you would see this repeated over and over and over again.
And I think that growth that we've experienced in deposit market share has translated into our loan volumes, and it's translated into our stock price. We have our last 5 years of our stock valuation posted on the board here, but we get a valuation each year. It's something we need to do for a variety of reasons, but we have an independent party evaluate our stock based on growth in book value is the basic measure. It does not include any dividends, but our stock in 2012, post-recession, reached $21 a share, and it's grown to $31.25 based on our valuation since that time. From a dividend perspective, we have a similar up and to the right model. We paid 35 cents a share in 2012, paid 60 cents a share in 2016. It's important to our board to pay dividends and to honor the stockholders that have put their trust in our bank. But our dividends impact our capital, and we need capital to grow. So as our bank has grown, which we've done successfully this year and in the years prior, our dividends impact our capital. That impacts our ability to grow. So whether this trend continues at the same pace, it's tough to say. It just depends on where our opportunities lie within the bank. But thus far, we've been very excited and pleased to pay dividends at this pace.
One thing that I'm really proud of is if you look at that little box in the upper right-hand corner, is if you had bought our stock when we first issued it in 2003, including the dividends that we've paid, your compound annual growth rate of your investment would be right at 10.4%. So you probably could have had some other investments that you could have made in 2003 that if you had held the entire time would have been better than that, but that's pretty good rate. We think it's been a great investment in the community, but we think it's been a pretty good investment, financial investment too. So we're pretty proud of what our original investors have done with their investment in the bank.
Last year at this time, we would have had a slide of our new building in Gunnersville that was under construction. Then we moved in actually in June of this year. That building has been everything we'd hoped for and more. But just yesterday, we opened a new facility in Coleman as we continue to try to expand the bank's footprint. It's our 8th office. We also operate a loan production office. You may hear that referred to as an LPO from time to time. We operate one in Blount County in Aniana and opened an LPO in Coleman in early 2015. That LPO grew in loans to about 31 million, and it made sense for us to go acquire a property in Coleman. This is the old Parker Bank building. The Coleman footprint is a natural extension for us. It feels a lot like the markets we already serve. Mike mentioned the market for deposits in Marshall County at $1,545,000,000. Coleman is actually a little bit larger at $1,628,000,000. So this building is, again, it's a 66-year-old building that we've renovated, opened yesterday, and we have a lot of excitement around this and high hopes for our Coleman operation.
We showed this slide to you last year, and it's something I'm pretty passionate about. We'll probably show it to you every year that we do this. It is an absolute fact that communities that have community banks operating in them do better economically than those that don't. And it goes back to that slide that I showed you about the market share declining for the holding company banks and market share increasing for the community banks. And the reason is we make an absolute commitment. Charlie's going to show you a picture in a few minutes of our lending staff, and it is significantly larger than the commitment that the holding company banks have to lending money in our markets. We absolutely make a commitment to lend the money that we take in deposits back in the markets that we take them in. A lot of the holding company banks take the deposits that they gather in rural communities like this and take it back and lend it in population centers like Huntsville, Montgomery, Birmingham, Nashville, Atlanta, where they can make larger loans and it's more efficient for them to lend money. We don't do that. You know, we're lending the money right back where we gather it. And we have an absolute commitment to do that, and that is much, much better for the economies that we operate in. You know, we're in Guntersville, Albertville, Arab, New Hope, Hazel Green, Rogersville, Elkmont, and Coleman, and that's where we're going to make our living. We're absolutely committed to do that, and it's much, much better for those economies for us to be lending it back right where we gather it. It doesn't take a lot of thought process to figure if we come into a community and take all the deposits but don't have a lender there lending it back and take those deposits somewhere else, that's not good for the local economy. And we've got a lot of competitors that are doing exactly that. And most of the marketplace is recognizing that. Thus, those banks have lost 20% of their market share in Marshall County, and it's happening all over North Alabama. Those banks have changed their focus, and it's not on these markets. But we absolutely are finding our focus here and are finding really good success in these marketplaces, and we plan on continuing because they're good, vibrant markets that are supporting our bank very well.
And that's a natural extension of that is for us to be involved in the community. Part of the vision of our bank is to be a bit more than just a deposit gathering and lending institution. We try to be engaged in the community, try from an education perspective, be participants in activities that are going on, and really just try to be a leader with our staff and the passion that we have around it. We have a golf tournament every spring that the Citizens Charity Classic. We've raised $105,000 through the first 3 years for the Northeast Alabama chapter of the Fellowship of Christian Athletes. We're highly involved in the United Way. We're involved in the chambers. And most recently, we started our Spirit of Citizens campaign. It's 90 days new. And we're allowing our employees an opportunity to find things that they have a passion around and be engaged from a volunteer standpoint, paid time away from the bank to be able to do this. And we're very excited about it, and we've had a lot of employee engagement to date, and I think it's a tremendous benefit. If there are those of you out here that are tied to something that you perhaps need a volunteer for, we may have somebody that fits that need. We've tried not to build a tiny box around what opportunities that exist for our employees. They have varied passions, and it's a wonderful opportunity for them to get to spend some time away from work, because many times their volunteer time would otherwise be occurring at times they needed to be at work. Mike mentioned our lending team. We have a big staff. This is about 20% of the employees, though, that we have in Marshall County. These are the individuals that you would typically see if you came into the bank or hopefully have called on you at some time in the past. We started adding up the numbers of years experience, and we quit because we realized that it made us all sound old. Most recently, though, we added a group of mortgage lenders from within the market that had augmented our mortgage department. We brought on three new staff members there, talented, knowledgeable mortgage lenders that understand the market very well, have been here for a long time. They fit our culture. They're a great fit for our team, and we expect wonderful things out of our mortgage area. The mortgage world has really changed, and it takes a knowledgeable staff to make it happen. So we're excited about what the future holds there. And another group that is just joined at the hip with our lending staff is our credit administration and loan operations function. These are, in a community bank or in a bank period, the largest assets oftentimes the loan portfolio, and managing the quality of the loan portfolio, helping the lenders in their underwriting, ensuring that we have high standards is what keeps us successful for years and years into the future. And this group is actually key to the success of the bank. Our lenders don't function nearly as well without them, and they're joined at the hip once again. And I'd put this group up against anybody at any other institution.
I'm a little old school, and a lot of people said that we needed to have a statement of purpose and core values, and I'm kind of go to work and do your job, and we are who we are. But I was convinced that we needed to put it down on paper as we got bigger and kind of got out of our original group. But generally, these things are executive management telling the group what you want them to do. And I said, well, if we're going to do it, I don't want executive management involved. So we weren't. A group of our employees got together and came up with our statement of purpose. And I'm really proud of what they came up with. And we don't apologize for what we are. We are an organization established on Christian values. We put that out there and don't apologize for it. We're proud that is exactly who we are. And I'm really proud of what our group came up with. And then our core values next. I won't read all of these, but the one at the top is we do the right thing. And I hope that's what you always find with our bank. We always want to be a bank that's puts integrity right at the top of what we do. We'll always do what we say we do. But I'm proud of our employees. I think they really captured the culture of what we've tried to establish in our bank from day one.
We've heard a phrase the last several years about the new normal, but what we've determined is that the new is kind of worn off. It just feels normal to us now. But we've been in this long recovery, probably not a super strong recovery. But it's a recovery nonetheless. But during the recovery, since the end of the recession, this 9 years or so, we've had a lot of things that have impacted, events that have impacted not just the United States, but the world. And we've put some of these up here. They're by no means drivers of great growth in gross domestic product. We've had the European debt crisis. We've had a hurricane back in 2012. We've had the federal government shut down. We've had recessions. And just last year, we were talking about Brexit. We were talking about the political uncertainty leading up to the election. And I think if we rolled that forward to this year, we'd be talking about North Korea, which we hadn't talked about much last year. We'd be talking about the Fed still seeking inflation. Obviously, we'd talk about Harvey and Irma and the hurricanes that are still out there, and the fact that worldwide debt has been increasing at a fairly dramatic pace. And none of these events are actually things that would drive our economy and drive our GDP to grow at any kind of robust pace. I think it's important to know the recovery that we've been in most recently is actually weaker than the recovery that occurred before the Great Recession, which was also weaker than the recovery before that. So whether it's something structural in the economy remains to be seen. But another thing that I found interesting was part of tax reform, the tax reform discussion is about repatriation of earnings. And there are companies out there that were polled to say, what would you do if you were able to repatriate all your earnings that you're keeping overseas? And it wasn't until the fourth thing on the list, which was finally capital expenditures, that actually has anything to do with growing GDP. So it's hard to envision, we have thankfully some experts to talk about that, but it's hard to envision anything really dramatically changing the pace of the growth we're seeing. We talked about some strategies. We've talked about these internally, and honestly, ours probably sound and look a lot like those of yours in your businesses. We've tried to increase volume over the last year. We understand that there's nothing that's really going to push us ahead so dramatically, economically speaking, and we were successful in doing that. Our balance sheet has expanded. We have a lot of people that have worked very hard, and so that has worked for us. We've evaluated new sources of income. I suspect many of you are doing that as well. For us, that looks like the expansion of our mortgage area and the revamping of our investment group into a full-on wealth management group. We're trying our best to manage cost. As we grow, it's a challenge, but I think it's provided that our growth and the results of our growth outpace the costs we're incurring, I think we're going to win there. We're trying to always keep an eye on service quality. As we grow and get bigger, we add staff and we open up in new areas, managing high-quality service, which is something that's meaningful to us and it's important. It's a big part of our core value. Our core values is the service quality, and we can't afford to sacrifice it. One thing we've most recently learned is attracting and growing talent is becoming more and more of a challenge. And I think we talk about this a lot, so much so that I'm beginning to think we need to be in the talent acquisition business at all times, no matter if we need them at that very moment or not. We've had instances where we've had openings that had we taken on someone perhaps when we didn't need a new staff member and raised them into that role, would we be better off? And I think the biggest concern that we're hearing out of small business now is it's not so much the labor force, it's the quality of the labor they're getting. And for us to grow as an institution, we have to grow our banking talent within the bank. And lastly, the understanding available technology, it's changing dramatically. I've never been accused of being a technologically savvy, but I know that I'm not keeping up within the bank of everything that's going on. Thankfully, we have individuals that really understand it, but it's not just in our business, and it's not just on our phones. It's in manufacturing. It's in healthcare. It's in all kinds of data flows that can impact and improve efficiency in business. And we're battling it in our business. There are companies out that compete with us now. They're known as fintech companies, financial technology companies that are small startups. Some of the stuff that they come up with is really, it's very neat stuff that would help us greatly in satisfying customer needs. Some of it we can take on. I think in the future, though, we're going to have to look at perhaps partnering with some of those smaller companies that do things that perhaps the banking industry as a whole just simply isn't nimble enough to handle. I think Mike, you have anything else you'd like to add? No. We're open for any questions. Otherwise, we'll just move through our agenda. Well, thank you.